Well, actually, the analogy would be you make a triple bogey and you put down par on your scorecard. That's what the Fed's doing, really. Tuesday, March 14th, 2023, Maneco 64, home of alternative economics and contrarian views. So today we're going to look at how the Fed has swept reality under the carpet. Yes, they're just buying time. Before we look into that, though, a couple of things I wanted to touch upon. First one is a quote by Hermann Hasse, who was a German-Swiss novelist in the 19th and 20th century. And he said this: those who cannot think or take responsibility for themselves need and clamor for a leader. I thought that was really interesting. I'd never seen that quote until yesterday, and I realized that's why I could care less pretty much what politicians try to do for me, for my own good. Yes, we need to see what they're doing, but very good quote, I thought, and hopefully that will help you with the way you look at things. The second thing is I wanted to talk quickly about a company that I've recently partnered with called Swift Refunds here in the UK. This is just for UK viewers, really. And what Swift Refunds do is they help mobile workers, people who are employed by companies and have to move around a lot in their jobs. They could be eligible for a tax rebate. So if you're interested, check the details below in the description. Swift Refunds. Of course, there's been a lot of talk about SVB and Signature Bank and the whole banking situation. We've seen people here in the UK like Rishi Sunak saying that the banking system is solvent and everything is fine. There's plenty of liquidity. We saw President Biden even come out and say, don't worry, your deposits are safe, right? And I've spoken about it, of course. We had a live stream with Clive and Rafi about what's going on. I spoke about it also on Saturday, saying that they need to inflate or die, basically, is what Richard Russell used to say. Richard Russell of the Dow, I think it was Dow Theory newsletter. He passed on a few years ago. He was like a legend, really. So there's a lot of opinions out there, and I'm fine with that. I have my own. But one thing I noticed about what the Fed is doing, and it's got all to do with these losses, that unrealized losses on investment securities, that I actually touched upon almost a month ago with John Titus. And at the time, we only had the data for the third quarter. The fourth quarter data is out now from the FDIC. So you can see the available for sale securities and held to maturity securities, all the losses that the banking system in the US, there's over 4,000 banks, all the losses that they're sitting on. And Rafi Faber made a video about this yesterday, and the Federal Reserve Fed website, which is the St. Louis Fed website where you can get a lot of data. They stopped publishing this when this number got to 80 billion. So they don't want people to see it, but the FDIC is still making it available. So I said that the Fed has swept things, reality, under the carpet. Well, basically what they've come out with, and with the help of the Treasury, of course, the Treasury is going to use 25 billion from the Exchange Stabilization Fund. What's the Exchange Stabilization Fund? Well, it goes back to 1933 when FDR, that great president, confiscated Americans' gold with Executive Order 6102. So I think SD Bullion has done a video about this. A quarter of all the gold was handed in. Some people, a lot of people kept their gold, of course. I don't know what they did with it, but they kept quiet. So what the treasury eventually got that gold. People had to hand it into their local branch of the Federal Reserve system. So, for example, if you're in California, you had to go to the San Francisco Fed. If you were in Northern California, or they might have had a branch in LA, and hand in the gold. And then the Fed passed the gold on to the Treasury. And yes, gold was made illegal to own as a monetary, as money. Up until then, people used to pay with gold coins, or $20 piece, or $5 piece, $2.50 piece, and that was all over. You had to use Federal Reserve notes now. That basically a promise to pay in lawful money, which really is nothing if you can't redeem it for a fixed weight of gold. So what happened later on in 1934, in the beginning of 34, there was the Gold Reserve Act, which revalued the price of gold from $20.67 per troy ounce to $35. So all that gold they confiscated from Americans at $20.67, that became worth $35. So with that profit, they used that to create the Exchange Stabilization Fund, basically a fund to manipulate the dollar. Seeing that now it was backed by nothing domestically, it was still backed internationally. And the British did the same thing in 1931 when they left the gold standard. So it's all about manipulation. So they've used this fund to back this new program that the Fed, this new sweeping under the carpet that the Fed has, to basically try to stop people from taking their money, or actually funds, because it's not real money. That's one of the problems with the system, from the banks. So here you go. The press release was on March 12th, 2023. Federal Reserve Board announces it will take available additional funding to eligible depository institutions to help assure banks have the ability to meet the needs of all their depositors. So here we go. This is the important part here. And it all looks really complicated, and it is supposed to be complicated, so you don't understand that they're basically ripping you off. And I'll come to that in a minute. So it says the additional funding will be made available through the creation of a new bank term funding program. Sounds really like great, doesn't it? Or BTFP, which is similar to, and Rafi noticed this too, BTFD, right? By the dip. Offering loans of up to 1 year in length to banks, savings associations, credit unions. Yeah, people ask, are credit unions safe? It doesn't look like it, does it? If the Fed is trying to protect them as well. And other eligible depository institutions pledging U.S. Treasuries, agency debt. That's like the Ginnie Mae's, Freddie Mac's, Sallie Mae bonds, and mortgage-backed securities, and other qualifying assets as collateral. And this is the important part here. This is the sweeping of trouble under the carpet, or sweeping what Rudy does under the carpet. Eventually it's going to smell really bad. These assets will be valued at par. What does that mean? Does it got anything to do with golf? No. Basically, well, actually the analogy would be you make a triple bogey and you put down par on your scorecard. That's what the Fed's doing, really. So we have to go back to that FDIC chart here. So basically what the Fed's going to do, they're going to take all these losses here and pretend there are no losses, right? and who's going to take those losses? Because the Fed is going to take all these securities, if necessary, from all these banking and depository credit unions, and they're going to put it on their balance sheet. And the Fed already has over $1 trillion of losses, and I've spoken about that with Clive Thompson. They're losing about $3 billion a day. So it's going to make the Fed's balance sheet even worse. And politicians like Biden, I saw, oh, we're going to make sure that banks are properly regulated from now on. Well, that's the exact wrong thing to do, to hide reality. And that's what they're doing. That's why I think even though it's too early to tell, are these banks really safe? I wouldn't be comfortable having too much in any bank, not just in the US, but here in the UK as well. So let's continue. The BTFP will be an additional source of liquidity against high quality securities, eliminating an institution's need to quickly sell those securities in times of stress. So are they really high quality? I mean, we've had problems with the treasury market and liquidity for many years, especially in the last 2 years. It's supposed to be the risk-free rate of return. It's supposed to be the safest thing on the planet. Of course, we know it's gold and silver, right? Those are the safest monetary assets. Are mortgage-backed securities really safe? Are the government-sponsored entity paper, are they really safe? I don't think so. So there you go. That's what they're doing. And how does this affect you? Because some people say, well, you're not paying for it. The Fed's paying for it. Well, the Fed has issued something called dollars, Federal Reserve notes. And that's their liability, and it's your asset. It's your currency. So the Fed is the issuer of the currency. So if their assets are rubbish, and they're taking more rubbish from other banks, how's their liability or your asset gonna be valued at? Well, it's not gonna be very good currency, is it? And that's why you're gonna continue to see the loss of purchasing power in that currency, because investors, foreigners especially as well, they're going to see this and they're going to say, why do I want to hold this? This is a really shaky, trashy currency, and the Federal Reserve is hiding everything, sweeping everything under the carpet. Eventually, people are going to pull the sofa or lift the carpet, and they're going to find a pile of, you know what, I don't want to say it here on YouTube. So that's what's going on, really. So with that, let's quickly look at where the markets are this morning. It's 8:17 a.m. London time. We've got spot gold at 19.09. It's down about $4, just over $4. Yesterday, I think when I spoke in my video, we hadn't broken through 1900 yet. So yeah, gold and silver did very well yesterday. I think the stock market was off a bit. The Dow, I think NASDAQ was up slightly. I see the Asian markets, stock markets are in the red today. Anyway, the high's been 1915 and the low 1901 overnight. We got spot silver unchanged at 21.78. I think silver was up over 5%. I think there's still a lot of room for gold and silver, especially for those of you who think in dollars. To think that gold is still at 1900, it's crazy with all that's has gone on in the last 12, 13 years. I actually think we are on the cusp of gold breaking out and really going ballistic, and silver as well in US dollar terms. The Dow futures up 63, the NASDAQ future 100 futures up 38, and the S&P is up 12 points. I expect a lot of volatility though, and today we have the CPI numbers out of the US, and they're out at 12:30 today UK time, or 1:30 Eastern time. I think it's expected to drop from 6.4 to 6%. And there's an old quote, or an old saying, not an old saying, but recently a European politicians from the European Parliament or whatever, Jean-Claude Juncker, he said, when things get bad, when you have a crisis, you need to lie. So I wouldn't be surprised if the CPI came out a lot lower than expected, and it will give the Fed even more of an excuse, aside from the trouble in the banking sector, not to raise rates next week. There are some Wall Street firms like Nomura saying that they're going to cut next week on the 21st. And the bond market, I mean, the way it moved yesterday, the bond market's screaming, saying the Fed's not going to raise anymore. They're going to start cutting probably by the end of the year. So we'll have to see for those numbers. To the currency market, we got sterling or cable down a third at 121.46. The euro's down a third as well at 106.95. Dollar's up 0.5% versus the yen, 133.92. And dollar's up a third versus the yuan at 687. Aussie dollar is unchanged, 66.63. Dollar is unchanged versus the loonie at 137.26. And the Kiwi dollar is also unchanged at 62.20. To the general commodities, platinum is down 10 bucks, trading around 991. WTI crude is down 1.3% at 73.86. Brent crude is down 1.2% of 79.50. High grade copper is down 0.7% at 402. We'll quickly look at the U.S. Treasury market. The 10-year yield is now up almost 4 basis points at 355. It has been as low as 346, and don't forget, we got up above 4% just recently. And the 2-year, well, that's been as far down as 383 earlier on today, and it's now at 406, up 3 basis points as well. And just have a look how the Treasury market moved yesterday. I took a screenshot at the end of the day yesterday. As you can see here, the 10-year was down 15 basis points. The 2-year was down 58 basis points. I mean, I've worked in the bond markets. I worked in the bond markets for a couple of decades, and I've never seen moves like this. Very rare. Even the 3-month yield came down 16 basis points. The 6-month came down 43. That means, as I said, that the market expects the Fed to basically pivot. And the same thing happened with the gilt market. The gilt market came off a bit yesterday. Yields came off. So yes, you can expect other central banks to start pivoting, even though prices are still rising, or what people call the inflation rate, which I don't like to call it. Things like CPI and RPI in the UK. Central banks, they're going to stop raising rates, and they're also going to have to stop unwinding their balance sheets, or what they call quantitative tightening. And why is that? Well, how can the Fed keep selling these securities that it's supposed to be buying now from banks? It doesn't make sense to be buying these crappy securities from these troubled banks and valuing them at par, and then going into the market and selling them at their real price, or also letting them run off their balance sheets. It's just going to make the trouble worse. It's just going to pile on the losses for the Fed's balance sheet, and it's going to pile on losses in terms of purchasing power of the currency that they issue. So the Fed is basically foobarred, I would say. That's the term, a term used during World War II. Hopefully some of you know what it means. If you don't, just Google foobar, F-U-B-A-R. With that, I'm going to wish you all a very good day. Take care. Bye.